So good morning everyone, or good afternoon, depending on where you watch us today. My name is Beatrice Richebom. I am the Director General of ecoDa, and I'm delighted to introduce this webinar organized jointly by ecoDa and Mazars on the Corporate Sustainability Reporting Directive. Given the topicality of the subject, we have decided to dedicate 2 webinars on the CSRD. The webinar of today aims to address the content of this directive in general, while the webinar of tomorrow will focus a little bit more on the roles and responsibilities of board members and how to obtain quality reporting. In case that you cannot attend those 2 webinars, be aware that they will be recorded and uploaded on ecoDa's YouTube channel. We have organized Q&A sessions throughout the webinars, so I invite you to use the Q&A button at the bottom of your screen and not the chat function that will allow us to track your questions. But without further ado, let me introduce to you our panelists. We have with us today Emmanuel Thierry. Emmanuel is a partner within Mazars sustainability team in Paris, and is leading Mazars CSRD task force that aims at positioning Mazars as a trusted advisor and auditor on sustainability reporting in Europe and globally. We have also with us Carole Mazon, is a partner at Mazars working in the technical department. She is a CSRD expert participating in many working groups in France and Europe level. And last but not least, we have Patrick Parent. Patrick is the chair of a committee of European auditing oversight bodies. So welcome to our experts, welcome to our participants. And let's start with you, Emmanuel. Do you want to take the floor?
Thanks a lot, Beatrice. Good morning, good afternoon, good evening. So Mazars has organized this webinar together with ecoDa and Patrick Parent from the CEOB in order to give ecoDa's members a broad overview of the basic information that we believe is relevant for board members to know about the CSRD. So this webinar is not the first one. This follows ecoDa workshop that took place a few months ago, and typically this preliminary workshop allowed for a clear confirmation that governance and management bodies of large enterprises in all of Europe understand and realize the growing importance of the extra financial information, and more particularly of the CSRD, and that they want to learn more about it. So I think the number of attendees today is actually a confirmation of that interest and criticality. I understand from Beatrice that this is a record number of attendees with more than 700 people. So that's we're very happy about that, obviously, but we're not that surprised because that's really the topic of the day. So our presentation is not designed, and that may be a first disclaimer I want to make. Our presentation is not designed to help ESG or CSRD specialists who may be already more advanced in those areas. But the purpose is really to reach out and brush the landscape for those who are at the beginning of their CSRD journey. Board members and executives will shortly have to grow their competencies in this field so that they can make decisions, but also bear the responsibility for their firm's disclosures and strategies as mandated by the CSRD. So there will be, as Beatrice mentioned earlier on, there will be another Mazars and ecoDa webinar tomorrow, and we will dig into more details a little bit more. But so what are we going to talk about today in this 90 minutes that are coming up? We have divided our presentation into four sections, each followed by a Q&A session. The four sections aim at covering the key information and bring a sufficient basic understanding of the CSRD for board members and executives. So first, we will give an overview of how the CSRD fits into the EU regulatory framework and what are the key features of the CSRD. Second, we will share a first look at the new reporting standards that are mandated by the CSRD, those called the European Sustainability Reporting Standards, or ESRS. Third, we will shortly remind you of some of the key matters of attention for companies to consider when they are embarking on a CSRD compliance project. And finally, we will touch on the new role of auditors and of the audit committee together with Patrick. So that's the program. That's the program for today. But let's start by going back in time a little, if you want, to better understand the context of the CSRD and where we're coming from. It's important to understand that the CSRD fits into a timeline and a wider economic and social strategies that can be said to originate in 2015 with the COP21 and the famous Paris Agreement. So, of course, there were discussions around ESG before the Paris Agreement. One can recall the Brundtland Report in '87 or the Kyoto Protocol in '97, whereby some countries committed to reduce their greenhouse gas emissions. And also, we should also be reminded that many countries already before the COP21 had local legislations around ESG and in some cases ESG reporting, like the EU with the non-financial reporting directive of 2014. But in many ways, the Paris Agreement, with its flagship ambition to keep temperature rise below 2 degrees, kicked off a number of initiatives and forced countries, well, starting in Europe, to design an agenda to address the key environmental issues of our time. So in that way, it seems that the sustainability objectives of the Paris Agreement have resonated with the values of the population, in particular in the EU, and this is obviously the instrument of the political will of decision makers. So a number of new legislations have since been enacted to achieve these commitments found in the Paris Agreement, and their names should belong, I believe, to the corporate vernacular of any board member or executive of the EU. This is part of what is expected today from people in business to be knowledgeable about those key issues around sustainability. As I like to tell my partners at Mazars, you can't really talk to a client anymore if you're not talking about sustainability. You might be missing the point of what is important for them. So this strategy was reaffirmed by the EU through the Green Deal in 2019, which to some extent paves the way forward until 2030 and even after. So the key point that is relevant for us today is to understand that the overall approach is to ensure a redirection of capital flows towards sustainable goals. This makes the financial system with banks and asset managers to begin with at the center of the entire agenda. So the sustainable goals are not necessarily being achieved only through forbidding certain behaviors like, and we've heard about that recently, driving cars with internal combustion engines, but rather through incentive mechanisms that start with transparency on how sustainable the business activities are conducted by the enterprises. Hence, the SFDR and the taxonomy, two of the critical new legislations that also should belong to the corporate vernacular of any manager in Europe. And those regulations bring the following answers to stakeholders, and more particularly to investors. First of all, how ESG risky or sustainable investments really are. And second, and that's obviously very critical, what activities are actually sustainable and how sustainable are they really. So I think it's important to keep in mind, because we'll be talking a lot about CSRD, but it's important to keep in mind that the taxonomy in particular is bringing the key rules to classify activities and to respond to the key questions of how much a company is aligned with the EU sustainability objectives, with very simple to understand KPIs, a percentage on turnover or percentage on CapEx. So together with the ESRS, that brings details and qualitative disclosure, the taxonomy reporting will constitute the backbone and bring the necessary data to allow for reallocation of financial flows to make the EU economy more sustainable and carbon neutral in line with the Paris Agreement. So now that we know a little bit more how the CSRD fits within a timeline of change and of transformation in Europe, maybe let's think about why the CSRD was needed. So I've made mention of the EU Green Deal already, and it's probably worth coming back to it and look at it in more details, as it gives the immediate context of the creation of the CSRD and gives also the background of some of its features. So to understand the CSRD well, it's also good to understand the Green Deal well. So the Green Deal is the EU main new growth strategy to basically transition the EU economy to a sustainable economic model. It was presented in 2019, at the end of 2019, so right before COVID. And the overarching objective of the EU Green Deal is for the EU to become the first climate neutral continent by 2050. So as you can see, we don't go only to 2030. This strategy goes up to 2050. So that should result in a cleaner environment, more affordable energy, smarter transports, new jobs, and an overall better quality of life for Europeans. Those are some of the key objectives. But we can see here some strategic goals for the EU. Strategic in the sense that we're talking about transforming the EU economy to be more sustainable. Second, we're trying also to make the EU a global leader in this area. And we design a European climate pact to achieve certain specific objectives. So the plan is to review each existing law on its climate merits and also introduce new legislation on the circular economy, building renovation, biodiversity, farming, and innovation. So you can see on the slide the various topics where the EU Green Deal has set its ambition. One of them is related to climate and to achieve climate neutrality. The EU has set an objective of reducing its GHG emission by 55%, that's a Fit for 55, in 2030 versus a 1990 level. And this will correspond to minus 40% compared to 2019, and may still be insufficient, by the way, when considering the objective of the Paris Agreement to keep below 2 degrees. So, however, the EU Green Deal also clarifies a number of things, and that's quite important. it clarifies the need to finance the transition to a more sustainable economy, and that must be a transition that must be fair. So financing the transition and redirecting investment flows within a relatively short period means a need to efficiently direct massive investments to activities that are aligned with the Green Deal ambitions shown on the slide. So to do this, there is a need for a clear identification of sustainable investments and activities, and this can be made only through a standardized, high-quality sustainability language as robust and widely recognized as the language we have for financial information such as the IFRS or US GAAP. And this is the purpose, this is the why we needed the CSRD. But the CSRD was actually not the first attempt in Europe to promote and regulate the disclosure of non-financial information. So prior to it, there was a NFRD. And it's important sometimes, again, to go back in time and remember that. The NFRD, Non-Financial Reporting Directive, was adopted in 2014 by the European Union. And the point was to require certain companies to provide non-financial disclosures along with their annual reports. The scope of the NFRD was relatively restricted. Even so, it has been expanding in certain countries through the transposition effort. So, for instance, extending to non-listed companies in some countries or to companies with more than 250 people, so lowering the threshold in Sweden, for instance. Companies to be subject to the NFRD had to be large public interest with more than 500 people. I'm just simplifying here, and thus covering basically the large listed companies, financial institutions, and insurance companies. So there were approximately 11 to 12,000 companies in the EU subject to the NFRD. And that was definitely part of the plan of the EU strategy to encourage corporate social responsibility. So in addition to the usual annual management report, what did it ask companies to do? It required disclosures in the following matters: environmental matters, social and employee issues, anti-bribery and anti-corruption issues, diversity, and respect for human rights. So the disclosure asked companies to outline what their risks are with regards to these issues, the resulting policies that the company has adopted in an effort to mitigate this risk, of course, and the outcome of these policies. These detailed reporting requirements are an annual public reporting obligation for those companies that are subject to NFRD. So with regards to how the non-financial information should be disclosed, companies can adopt a variety of benchmarks to help them complete the disclosure process. For example, this may be a mix of national, international, and EU guidelines. So overall, and I think it should not be disregarded, it has been a significant step forward in terms of extra financial reporting, and also it has been a game-changing initiative at that time. And beside the NFRD, it should be noted as well that there are other relevant sustainability disclosure requirements in the EU that were enacted in the few years before the CSRD kicked in. Most notably, we will talk about SFDR, so the sustainability-related disclosures on the financial services sectors that require financial market participants and financial advisors to disclose sustainability information at the company and at the product level as well. But we can talk about CRR, CRD, and the one and so forth. So there were plenty of new regulations coming in. So at first sight, you can believe that the landscape for ESG regulation seemed to be pretty complete already before CSRD. However, what has been observed is that many companies have also used the flexibility offered by the NFRD to use the annual report as a communication tool, opening the door to claims of greenwashing. As explained before, one of the major flaws of the NFRD was that it doesn't define how to report on the ESG aspects. Companies are free to use voluntary frameworks and standards, so GRI, TCFD, SASB, and so on and so forth. So the NFRD, at the end of the day, suffers from several deficiencies. First, and that's the main one, there is a lack of comparability, reliability, and relevance of the non-financial information that is provided by companies. And that's really the heart of the problem. Second, there are obviously overlaps with all the new regulations I was talking about earlier. There are overlaps between different pieces of legislation on sustainability reporting, which causes uncertainty around the reporting requirements. There is also high demand. The market is changing, and there is high demand for common reporting standards of better quality. Stakeholders want companies to disclose their materiality assessment process as well. And there is, generally speaking, a requirement for all information to be disclosed in the management report to create that consistency that is needed. So to address all these flows, and there are others, here I'm trying to be aware of time, to address all these flows and further advance the objectives that were set in the Green Deal, the EU has voted at the end of 2022 a new set of regulations called the Corporate Sustainability Reporting Directive, or CSRD. So what are the key features of the CSRD in a nutshell? So we can identify four main aspects of the CSRD when compared to the NFRD. And you can see them on the slide that is presented right now. The first one is that the CSRD proposes an enlarged scope of application with new, lower thresholds. This is very much in line with the understanding that this new regulation is to run deep in society to trigger an actual transformation of the economy, and at the same time ensure that supply chains get aligned with the requirements of the larger players. Second, and maybe most importantly, the CSRD plans for a mandatory sustainability reporting standards regime, prescribing content and format of information to be disclosed. The elaboration of the standards has been left to the European Financial Reporting Advisory Group, or IFRAG, which had already played a key role in the preparation of the CSRD itself. Third, and obviously that's something that I am personally very sensitive to, the CSRD plans for mandatory assurance of sustainability report. This is something we will discuss more in detail in the last part of this webinar together with Patrick. Fourth, and it is quite important, it leaves very little room for maneuver, with few options left for decision at the level of member states. Remember, the CSRD is an EU directive, so transposition is to be done at the member state level. But here, there are very few options. The point is to trigger a strong level of comparability between countries. So one thing that is very important also about the CSRD is that all those four aspects I've been talking about, that give some certainty and perspective as to the direction of reporting obligations until 2030. There are some discussions around certain features of the CSRD, and I know that Carol will be talking about that a little later, but the direction remains the same and companies are getting prepared. The certainty over this future should trigger an acceleration of the transformation and the build-up of a large ecosystem of professionals, data providers, software editors, rules and their interpretations, in addition to the expected changes in allocation of capital towards more sustainable activities. But now I think Carol will now give us a more detailed view on the CSRD.
Thank you, Emmanuel. So where are we today as regards this new regulatory framework you've presented? So the final text of the Corporate Sustainability Reporting Directive has been published in the official journal of the European Union mid-December last year. It was the outcome of a political process that lasted several months. The CSRD is a so-called level 1 text, and therefore it requires transposition into national law in each member state. And this will have to be made by 6 July 2024. We really advise you to follow this process because each country has to decide on the options offered by the directive. And even if there aren't that many, some topics are really key, notably as regards who will be able to provide assurance. And the national law will also specify the scope of the directive according to the legal forms of companies. So this is something you should keep in mind. And then we have level 2 texts deriving from the CSRD, which are the ESRS Emmanuel has already mentioned. So you should know that under the directive, EFRAG, as mentioned by Emmanuel, has been appointed the technical advisor to the European Commission. So it is in charge of developing draft ESRS, and this is important. We are only draft at this stage. So EFRAG delivered the first draft of sector agnostic standards last November. And this is what we call set 1 of ESRS, and it includes 12 draft standards. And I will come back to this in a few minutes. And since November, the EC has followed the due process that is required by the CSRD, and it has notably consulted European supervisory agencies and member states. It also received unsolicited feedback, mostly from preparers. So we are now waiting for the draft delegated acts that will be issued for public consultation by the EC for a 4-week period. And then the EC will adopt the final standards by way of delegated acts. And the option will be followed by a scrutiny period of maximum 4 months by the Parliament and the Council. The theoretical calendar as per the CSRD is an adoption of delegated acts by the end of June, but set 1 will probably be adopted a little bit later than expected. There is indeed, and you should know about that, a lot of turmoil at the moment around ESRS, with many questions around the calendar and even the content of set 1. You may have heard that President Ursula von der Leyen announced mid-March that by the autumn, the EC will put forward concrete proposals to simplify reporting requirements at large. It will not concern only sustainability reporting. And in fact, the EC wants to reduce them by 25%. So it's obviously a political direction in order to rebalance things, I'd say, a little for European companies. And at this stage, we do not know where this is to come up in the end. We will have more details on the decisions that Europe will make, and notably with the draft delegated acts on set 1, and that we now expect in May instead of beginning of April initially. So let's now take a little bit of a step back to see how sustainability reporting fits into the financial communication of companies in the broad sense. So corporate reporting must form indeed a coherent whole. It is made up of different layers covered by several regulations. So ultimately, companies must ensure that all the information they report on is consistent and connected to the greatest extent possible. A key component of corporate reporting are, of course, the financial statements. You probably know that market regulators and investors now expect that financial statements to be fully transparent about the financial effects of climate change. And we expect more guidance from standard setters in this regard in the coming future. As for the risk factors in the universal registration document, they are key for enabling investors to make an informed investment decision. And this information, of course, covers broader risks than just ESG risks. But again, the information provided must be consistent with all the pieces of corporate reporting. And then we have all the information contained in the management report. And starting January 1st next year, all companies in the scope of the CSRD will progressively have to publish sustainability statements prepared in accordance with ESRS. And be aware that these will also include taxonomy information. And also know that ESRS sets specific requirements to ensure that connectivity is made with the financial statements, and that the relationship between different pieces of information are adequately described. It will also be possible to incorporate information in the sustainability statement by reference to information provided, for instance, in the financial statements or in other parts of the management report. And we have also shown here the SFDR layer. Emmanuel mentioned earlier. This regulation concerns primarily banks, insurers, asset managers, and so on. But indirectly, it requires non-financial companies to provide information that financial companies need to meet their own reporting obligations. So that's why we mentioned this on this slide. And all this is to be considered in the context of the move towards a wider implementation of the electronic reporting, and we'll talk about that later on. So we have reached the end of the first part of this webinar, and let's see if you have any question. Beatrice?
Yes, indeed, Carol. We have a first question from our participants. We have this question: when will the CS3D dealing with due diligence enter into force, and what is the interaction with the CSRD? Emmanuel, over to you. We can't hear you, Emmanuel.
We are. Thank you for the question. So CSDD, it's another acronym that's starting to be a little tricky, right? We have SFDR, CSDD, or CS3D, CSRD, and so on and so forth. So with regards to the implementation, the calendar is not determined yet. That's something that's quite clear. The Parliament is expected to vote on the draft text at the end of May, and then there will be negotiations with the Commission and the Council that will start during the summer. So if everything goes well, this could lead to an adoption of the CS3D of the final text at the end of this year, with an entry into force at the earliest in 2026. With regards to your second point, the CSRD refers to the sustainability due diligence process by reference. And at this stage, it makes reference to the related international instruments, which are those from the UN and those from the OECD. And it is expected to be further updated once the CS3D will be put in place, so that we have an alignment between both texts. What is expected is that the CS3D should also define more precisely the value chain, which is a key concept of the CSRD, where we have, to be honest, a lot of discussions with clients right now to make sure that everybody is on the same page.
Thank you, Emmanuel. I can see another question, and this question refers to the extent to which the CSRD and the CFRD interact. Emmanuel.
Another one for me. Very good. So the CSRD is relatively explicit in requiring that sustainability reports include at least the information that financial market participants need to fulfill their SFDR obligation. So things are done one after the other, and the SFDR wants an anticipation of the CSRD. Therefore, all of the SFDR PAI, principal adverse impacts indicators, have been incorporated by the EFRAG in the set 1 of the draft ESRS, and they mandate the disclosure of all these indicators in all circumstances. So that means that financial market participants, banks, investors, and so on, will have access to that information once the CSRD is fully in place, irrespective of the outcome of the materiality assessment. So, but I believe we will come back to that in a few minutes, thanks to Carol.
Thank you, Emmanuel. And indeed, Carol, shall we come back to you?
Yeah, thank you very much. Thank you, Beatrice. Just waiting for the slides. Yeah, thank you. So let's now talk about the ESRS. Let me first present you the key features of sustainability reporting in the EU, and obviously they are based on the CSRD requirements and on the orientation taken by EFRAG in elaborating the draft ESRS. So the approach adopted here is more a rule-based than a principle-based approach, The objective is to ensure the quality, the relevance, the comparability of the reported information. And this will be done through 3 interconnected layers of information, with first a sector agnostic layer and then a sector specific layer. And both of them will be based on the ESRS as adopted by the EU. And finally, there will be also an entity specific layer to ensure that in the end, a company provides all the material information covering its sustainability matters. The ESRS will require granular information in the form of both qualitative and quantitative information, and they will adopt both a retrospective and a forward-looking approach. A very important point here also is that, as requested by the directive, the ESRS adopts a double materiality approach, meaning that an entity will have to provide information on the impacts a company has on the environment and the people. But the company will also have to report on the financial effects on it of its sustainability-related risks and opportunities. And the objective here is to cover effects that are not yet or partially covered, included in the financial statements. So note that the double materiality assessment will have to be made not only regarding the entity's own operations, meaning the mother company and its subsidiaries, but also including its upstream and downstream value chain, which raises many practical questions, notably for the financial sector. And the CSRD also requires that the full spectrum of E, S, and G topics are covered through topical standards, for instance, with the standard ESRS E1 on climate change. Emmanuel presented earlier how the CSRD interacts with other EU sustainability legislations. While ESRS have logically been consistently drafted considering these, the sustainability statements will therefore include the information to be provided, obviously, as regards taxonomy regulation. Besides some information listed in the ESRS will be mandatory, consistently with the reporting requirements for financial companies. And we mentioned earlier already the interaction with the SFDR. Another very important point is that the CSRD requires that the ESRS be interoperable with other sustainability reporting frameworks. In practice, the ESRS has built on various existing frameworks or standards, such as the reporting pillar of the TCFD. EFRAG has also worked closely with the GRI, the Global Reporting Initiative. It has also worked with the recently created ISSB, the International Sustainability Standards Board, which was established by the IFRS Foundation in November 2021. And the ISSB is intended to develop IFRS sustainability disclosure standards. So in practice, if a European company that is required to apply ESRS also wants to apply IFRS voluntarily, there will be avoidance of dual reporting on whatever is similar between both sets of standards. That's the goal, both from the EU and from the ISSB. And last, sustainability statements will have to be both machine readable and human readable. In this context, the European single electronic format already used for the financial statements will have to be applied, and sustainability statements will therefore have to be tagged using an XBRL taxonomy specifically developed for this purpose. Let's now have a look at the main items that will have to be addressed by the sustainability statements. But let me first stress a very, very important point that you should keep in mind as we speak about CSRD and ESRS. Because consistently with the fact that the CSRD is a directive on sustainability and reporting, and therefore does not mandate any behavior from companies, ESRS will not mandate any behavior. So if I take, for instance, ESRS E1 on climate change, E1 does not impose to have a transition plan in line with the Paris Agreement, but it is intended to improve transparency about what a company does or does not do. So if your company does not have a transition plan put in place, it will have to indicate this, and it will have to maybe specify when it will adopt such a plan. So as you can imagine, indirectly, the CSRD will lead indeed companies to transform themselves. But again, the directive formally only sets sustainability reporting obligations. So on this slide, we present a summary of what is listed by the CSRD as regards the information to be provided in the sustainability statements. And it has been the roadmap for EFRAG to elaborate on draft standards. So I won't go here over everything, but you can look at this, of course, later on. You should remember that a company will have to provide all the material information needed to cover in a relevant manner its sustainability-related impacts, risks, and opportunities, and over the short, medium, and long-term time horizons. And this will involve providing information on how governance addresses sustainability issues and on how these issues interact with the company's strategy and with the company's business model. It will also involve providing information on policies, on the actions, on the allocated resources that are in place to manage the material issues identified. And of course, information is also required on how the company measures performance, including the progress made in achieving its objectives, its targets. So what is explained here, and as I will show you, is that the CSRD provides for different standards depending on the entities that is concerned. So the most detailed and demanding standards, obviously, will be those mandatory for large companies, and we will see the size criteria to consider in a few minutes. General ESRS will include not only sector-agnostic standards, but also sector-specific standards, as I briefly mentioned earlier. And according to the CSRD, the sectoral standards should be adopted by the EC by the end of June 2024. But EFRAG resources are limited, so the 40 also standards to cover all sectors will be published in stages. And this is even more true since Commissioner McGuinness recently asked EFRAG to prioritize work on the implementation of Set 1 over the preparatory work for the draft sector-specific standards. And therefore, EFRAG has adjusted its work plan to this new priority, and we don't really know what will come out of this. And then we have the standard that will be applicable by listed SMEs. So according to the CSRD, the EC should adopt the final text by June 2024. But considering recent announcements, this deadline is also being challenged. The objective here is to adopt a standard which is proportionate and relevant to the capacities and characteristics of listed SMEs. And this standard will also be applicable by small and non-complex credit institutions, and also by captive insurance and reinsurance companies. And all these entities will nonetheless be able to apply the general standards if they wish to do so. EFRAG will also develop a specific standard for non-EU groups, which will have to report as per the CSRD. But contrary to what the CSRD said, the standard should not be available by June 2024 because EFRAG has indeed not yet started working on it. And be aware that non-EU groups may also apply general ESRS or standards deemed equivalent by the EC if they wish to do so. And last, EFRAG will also develop a voluntary standard that unlisted SMEs will be able to apply if they wish to do so. So EFRAG will probably build on the work to be done for listed SMEs so that other SMEs will be able to identify which relevant information they will provide. So let's now have a look at the 12 draft sector agnostic standards that have been released by EFRAG last November. So this is the so-called set 1. So first, we have two cross-cutting standards with ESRS 1 being kind of a conceptual framework. It notably includes principles on how to conduct the double materiality assessment. Be aware that the standard does not include any disclosure requirements, meaning there is no information to be disclosed specifically in accordance with this standard. And then we have also ESRS 2 on general disclosures. And all the information listed in this standard is mandatory because you can find in there the basic information to report for all companies, and notably the information to understand the governance processes, controls, and all the procedures put in place to monitor and manage sustainability matters. Draft set 1 also includes five environmental standards. The information under E1 on climate change being mandatory for all companies. Other disclosure requirements in E2, E3, E4, and E5 are subject to the outcome of the materiality assessment to be conducted by each company in order to identify its material impacts, risks, and opportunities. However, you should know that some metrics are mandatory because they relate to other EU regulations, such as the SFDR. And then we have 4 topical standards to address social and human rights topics. Some information under ESRS S1 on own workforce is mandatory, but only for companies with 250 employees or more. So S1 is partially mandatory. And last, we have one standard on governance, which is ESRS G1 on business conduct. And this standard deals with matters such as protection of whistleblowers, corruption and bribery, political engagement and lobbying activities, but it also talks about payment practices, for instance. And in total, draft ESRS, so as approved by EFRAG at this stage, represent 82 disclosure requirements, and this is 40% less than what was included in the exposure draft issued in April last year for public consultation. So as you can see, EFRAG has streamlined its proposals as asked by many stakeholders. And each disclosure requirement consists of more granular information. So in total, this draft standard include approximately 1,100 data points, of which about 1/3 is mandatory, therefore not subject to the materiality assessment. So the 1,000 or so data points represent the maximum of the information to be provided under ESRS. We should now wait for the final standards because we need the confirmation of the content of the sector agnostic ESRS. As I mentioned earlier, the EC may make changes to the drafts prepared by EFRAG. So this is only the draft standards that we know at this stage. So let's now have a look at what's going on outside Europe, because that's interesting also to consider what's going on as regards sustainability reporting outside Europe. So I've mentioned earlier the IFRS Foundation initiative with the ISSB. One of the major differences between the EU initiative and this initiative is that the latter is an international private one. So each local jurisdiction will have to decide on whether or not it endorses IFRS sustainability disclosure standards. Companies will also be able to decide, European companies will also be able to decide whether they want to apply IFRS on a voluntary basis. The ambition of the IFRS Foundation is to build what they call a global baseline for sustainability reporting, which would be as widely applied as IFRS accounting standards. And as I mentioned earlier, and this is very important, EFRAG and ISSB are working together to achieve interoperability of both sets of standards, and an interoperability mapping table should be provided in the coming weeks to help prepare on that. So at this stage, as you can see, the ISSB has worked on 2 standards only, one on general disclosures and another one on climate, and they should both be released by the end of June this year. But the ISSB will soon consult on its work plan for the next 2 years, and it intends to include projects on wider topics on sustainability, such as biodiversity, human capital, human rights. They notably want to cover the topic of just transition. And if we now look at what's going on in the US, you may have heard that the SEC proposed rules in March last year to enhance and standardize climate-related disclosures. But there is a lot of pushbacks from investors, from companies, from lawmakers. So the final version of the rules is expected this year, that the SEC should make the requirements less onerous than originally proposed, especially regarding disclosures on Scope 3 GHG emissions. So we will know in the end where they will come up with this. So we have reached the end of the second part of this presentation. Beatrice, do we have questions on this?
Yes, indeed. I can see many questions from our participants, but let me take one of them. Can we expect significant changes in the delegated acts as regards the sector agnostic standards compared to the draft standards delivered by EFRAG to the EC last November?
Okay. Thank you, Beatrice, and thank you, because this is indeed a very important and very interesting question. So at this stage, we really don't know very precisely the full extent of these changes, but we can indeed assume that there will be some, notably in view of the different feedback that the EC has received, as I said, from member states, also from the European supervisory agencies, but also in the context of the upcoming simplifications in reporting requirements I mentioned earlier. So what we have heard, but it has to be confirmed, is that there will be additional transitional measures compared to what has been proposed so far by EFRAG. So we will see what the EC will decide. And it will be, of course, it will be very relevant to carefully follow the publication in the coming weeks of the draft delegated acts to have a better idea on the expected content of the final standards.
Thank you, Carol. Another question for you. Will a company have to publish all the information listed in ESRC?
No, not at all. The ESRS lists disclosure requirements and data points, and all the, I mentioned the figures a few minutes ago, but this is really a maximum. It is not expected to correspond to the average volume of information that each and every company will have to report on when applying ESRS. So even though around 1/3, as I said, around 1/3 of the information will be mandatory, 2/3 will be submitted to the materiality assessment to be performed by an entity. So really be aware that the objective here is that a company will have to report on its relevant information in order to address and to cover in a relevant manner its material impacts, risks, and opportunities.
Thank you, Carol. We can go on, I guess, with part 3 of this presentation, if you don't mind.
Okay, thank you very much. Yeah, so we have another part now that we will consider covering who is concerned and when does all this kick in. So first, let's have a look at the CSRD scope. As I already said, let me insist on the importance to closely monitor the outcome of the transposition of the directive into national law. It will be a key step. So the first batch of companies in CSRD scope consists of all large entities or groups, and this covers public interest entities, including obviously entities listed on an EU regulated market, as well as large unlisted entities. And when we talk about companies listed on an EU regulated market, these include also companies that are not domiciliated outside the EU. So by large, we are referring to companies that exceed at least 2 of the 3 following criteria at the balance sheet date that are shown here. So meaning 250 for the average number of employees, 40 million euro net turnover, and 20 million euro balance sheet total. These thresholds are set in the accounting directive that has been modified by the CSRD. And as you can see, as Emmanuel told you earlier, the criteria related to the number of employees has been reduced compared to what we had with the NFRD. The second batch deals with listed SMEs, meaning SMEs whose securities are listed on an EU regulated market. So securities means shares or bonds. EFRAG has estimated that this represents approximately 1,000 listed SMEs in the EU. And the SME category is once again determined on the basis of the thresholds set by the accounting directive that are shown here on the slide. Let me draw your attention on the fact that the CSRD is at this stage unclear on the level of reporting to be published by listed SMEs, meaning either at a consolidated level or only on a standalone level. So we hope this issue will be soon clarified, because of course it is an important one. And then we have a third batch that deals with non-EU groups, because the CSRD entails an extraterritoriality principle. It concerns also non-entities or groups with a significant activity in the EU. And these companies come in addition to the non-EU companies whose securities are listed on an EU regulated market, as I mentioned earlier, and which are included under batch 1 and batch 2. So the criteria here to determine the significant activity is that the turnover generated in the EU shall exceed 150 million euro for each of the last 2 consecutive financial years. And the group shall also have at least 1 EU subsidiary, either a large entity or a listed SME, or 1 branch in the EU, but this branch must generate more than 40 million euro turnover in the EU in the preceding financial year. So in this case, the report must be established at group level of the ultimate non-EU parent entity, covering all EU and non-EU subsidiaries. But this report will have to be published by the EU subsidiary or branch using specific ESRS or other standards deemed equivalent by the EC. And overall, it has been recently estimated that around 10,000 non-EU companies, which is a lot, will be concerned by the CSRD, either because of their level of activity in the EU or because they are listed on an EU regulated market. And last but not least, the CSRD requires to produce a sustainability report at entity level or at consolidated level where relevant. But in the latter case, an exemption is provided for subsidiaries to the extent that certain conditions set by the directive are fulfilled. However, you should know that this exemption does not apply to large listed entities, and they will therefore have to produce a report at their own level in any case, and possibly at consolidated level if they are themselves an intermediate parent company. So we are going to sum up the main steps of the CSRD implementation in relation with the development of ESRS. So first, in June this year, we expect that the EC will adopt set 1 of the ESRS via delegated acts, meaning the first 12 sector agnostic standards I presented briefly earlier. But as I mentioned, and as you should know, there is uncertainty currently around this timing. Then large PIEs with more than 500 employees currently within the NFRD scope will have to apply these standards for the first time in the sustainability reports published early 2025, covering the 2024 financial year. And in June 2024, the EC should adopt other ESRS, meaning the first sector specific standards and the standard for listed SMEs. It is, once again, the theoretical calendar as per the CSRD because some changes might occur. Then the 2025 financial year will be the first year of reporting under ESRS for the new CSRD large companies, including the listed entities for which the average number of employees is between 250 and 500, but also indeed for the large unlisted entities, which were not subject to NFRD. And in 2026, it will be the turn of listed SMEs, with first sustainability reports published early 2027, but they may choose to delay this reporting by 2 years. And let me stop here to add that non-EU companies listed on an EU regulated market will follow the same calendar as for EU companies and will have to apply the same standards. And finally, 2028 will be the first year of reporting for non-EU groups with significant activity in the EU, referring to the thresholds mentioned previously. So we have reached the end of this third part. Maybe there are also questions on this.
Yes, indeed, Carol. We don't stop receiving questions. Let me take a question related to taxonomy. Does taxonomy information will have to be published by companies not currently in the scope of the NFRD, but tomorrow in the scope of the CSRD?
Yes, indeed. Taxonomy-related information will have to be disclosed by all companies within the scope of the CSRD, and therefore also by companies currently in the scope of the NFRD, not in the scope of the NFRD. Therefore, we have not yet presented taxonomy information. And you should also note that limited assurance and then reasonable assurance will be required over taxonomy information, which will be probably a change compared to what has been done so far in the context of the NFRD.
Thank you, Carol. I can see that a lot of participants are asking us whether you will be able to share the slides with them. Can you confirm, Carol?
Yeah, indeed, of course. Yeah. The presentation will be made available right after the webinar.
Excellent. So thank you, Carol. Emmanuel, over to you for the last part of this webinar.
Thank you, Beatrice. Thank you, Carol. I assume that for some of the attendees, it's been a lot of information coming down to you. But now that we better understand where the CSRD is coming from, what it entails, and what should be looked at by companies, I propose that we now take a look at a critical feature of the CSRD, which is a mandatory assurance to be given on the sustainability statements and the ensuring expected role of the audit committee. But before we look at this, the new obligation from the CSRD, let's make sure that we all know where we are coming from in the EU with regards to assurance of NFRD reports, because it's quite important also to understand that we are companies are on a path to learn. It's a journey, and this journey has started also with the assurance work that was done on NFRD reports. So first of all, today, no assurance is mandatory as per the NFRD in the EU, but 3 countries decided to make limited assurance a mandatory feature of their transposition back in 2017. Those are Spain, Italy, and France. So all NFRD reports in those countries will have been reviewed by somebody, and some assurance will be given, generally based on local rules and also on the standard ISAE 3000. However, let's not forget that many companies make their sustainability reports subject to some assurance on a voluntary basis. For instance, the IFAC report on sustainability assurance was showing that 74% of German companies had some kind of assurance on their ESG reports. In addition, there was a minimum requirement that was anticipated by the NFRD, meaning that the auditor had to check whether the non-financial information has been provided, making the absence of non-financial information an irregularity that was highlighted in the auditor's report. Also, let's not forget that 11 countries have imposed that auditors develop some procedures in line with audit standards, ISA 720, to check the consistency with financial statements. But since the framework for assurance and for reporting was very flexible, and the governance of this audit was not given the highest importance to be very transparent, it has been argued that assurance requirements equivalent to those applied to the financial information are necessary to bring the sustainability information to the same level of quality as the financial information. I think, however, and that's what I alluded to earlier on already, I think, however, that the audit process that has been applied over NFRD reports has largely contributed to improving the overall quality of the ESG reporting in the EU over the last 5-6 years. Gradually moving from a communication exercise without the check of any professional eye to a more structured reporting. But now I'm happy to let Patrick tell us more about how the new standards, as required by the CSRD, will change the state of play in ESG audit.
Thank you, Emmanuel, and good morning, good afternoon, good evening to everyone. With regards to the standards to be applied by auditors and independent assurance service providers in order to produce an opinion on the quality of sustainability reporting, I think there's a particularly disturbing gap between the date of implementation of the reporting requirements for large European companies from 1st January of 2024 and what the directive foresees for the development of assurance standards at a European level. Indeed, the text provides that the Commission adopts limited assurance standards in 2026 and reasonable assurance standards in 2028. We would therefore have several years where auditors and independent assurance service providers would not have an adapted text in Europe guiding them on the assurance work to be performed. However, assurance on sustainability reporting has been given the highest priority by the International Auditing and Assurance Standards Board, the IAASB. The board intends to finalize its exposure draft in June 2023, which would allow for a final standard before the end of the year. During the first phase, the limited assurance will focus on, first, compliance with the CSRD, ESRS requirements. Second, the process carried out by the entity to identify information that needs being reported. Third, compliance with the requirements dealing with electronic reporting. And fourth, compliance with the requirements coming from Article 8 of the taxonomy regulation. In the second phase, it is expected that more extensive procedures will have been put in place, both by the reporting entities and by auditors and/or independent assurance service providers, and that the level of assurance being provided on sustainability information will be close to that being provided on financial reporting. As a consequence, the assurance report would take the form of a positive opinion. I think we now are moving to the next slide, which is dealing with which assurance provider and consequences on the assurance report. So the directive provides that member states may choose the option of allowing an IASP, independent assurance service provider, or an auditor, which is not the statutory auditor, to produce an opinion on sustainability reporting. Regarding professional ethics, independence, objectivity, confidentiality, and professional secrecy, the directive in a newly created Article 25b sets requirements to the IASP that are equivalent to those applicable to statutory auditors. As mentioned here in the slide, if the IASP option is chosen, the report from the IASP should be made available as an annex to the management report or by any other publicly accessible mean. Items for consideration by board members and audit committee members. Well, regarding the item that I just mentioned, if the IASP option is chosen, the report from the IASP should be made public together, meaning at the same same date, with the company's financial reporting. The audit regulation prohibits the provision of certain non-audit services over certain periods when the statutory auditor is carrying out the statutory audit. Services related to the preparation of sustainability reporting, including any consulting services, would be considered as services that a statutory auditor cannot deliver to its audit client. By extension, an auditor selected to provide an opinion on an entity's sustainability reporting will be submitted to the same constraints. In particular, the auditor will be prohibited from performing services that would contribute to the preparation of the sustainability reporting. The rule applied to audit firms reaches out to all firms in the same network. Transposed to an IASP company, the prohibition, in my view, would potentially apply to all entities belonging to the same group. If a member state opts for allowing ISPs to provide assurance on sustainability reporting, as connectivity between sustainability and financial information is key, changes to professional secrecy rules are likely to be needed in order to allow an exchange of information between the statutory auditor and the ISP. This is something, in my view, which is quite important. Next slide, on the role of the audit committee following the adoption of the CSRD. The audit directive now requires from member states that they ensure that each public interest entity has an audit committee and specifies its task with regard to the statutory audit. It provides that the audit committee should be assigned with certain tasks with regard to the assurance of sustainability reporting. Those tasks should include, first, the obligation to inform the administrative or supervisory body of the public interest entity of the outcome of the assurance of sustainability reporting. And second, to explain how the audit committee contributed to the integrity of the sustainability reporting and what the role of the audit committee was in that process. The audit committee shall also monitor the sustainability reporting process, which includes the electronic reporting process. And second, the effectiveness of the undertaking's internal quality control and risk management systems regarding sustainability reporting, and where applicable, its internal audit on that matter, which means that it includes also electronic reporting process. The functions assigned to the audit committee relating to sustainability reporting and relating to the assurance of sustainability reporting can, upon option, be performed by the administrative or supervisory body as a whole, or by a dedicated body established by the administrative or supervisory body. This is a member state option. The CSRD also results in a change to the Transparency Directive, which makes it necessary to require that the persons responsible within the issuer confirm in the annual financial report that, to the best of their knowledge, the management report is prepared in accordance with the sustainability reporting standards. The CSRD also results in changes to the accounting directive. There, in addition to the fact that undertakings shall include in the management report information that is necessary to understand their impacts on sustainability matters, and information necessary to understand how sustainability matters affect their development, performance, and position in a clearly identifiable section within the management report. The information shall also contain, first, a description of the role of the administrative, management, and supervisory bodies with regard to sustainability matters, and of their expertise and skills in relation to fulfilling that role, or the access that such bodies have to such expertise and skills. Second, a description of the entity's policies in relation to sustainability matters. And third, information about incentive schemes linked to sustainability matters, which are offered to members of the administrative, management, and supervisory bodies. Lastly, I would like to underline that the audit regulation requires statutory auditors to report irregularities to the audited entity, and under certain circumstances to authorities designated by the member states as responsible for investigating such irregularities. The regulation adds that such obligation should also be extended as appropriate to statutory auditors and audit firms as regard their work on the assurance of sustainability reporting of public interest entities. Well, this is it. I think there may be questions from the audience.
Yes,
Beatrice?
indeed. Yes, indeed, Patrick. We have a question for you. Which assurance standards shall be applied during the interim period until the adoption by the European Commission of the EU standard on limited assurance?
Thank you, Beatrice. The CSRD explicitly states that member states may apply national assurance standards, procedures, or requirements as long as the Commission has not adopted an assurance standard that covers the same subject matter. Therefore, this issue will be managed locally by each member state during the interim period.
Thank you, Patrick. I can see another question, and maybe that will be for you, Emmanuel. Is the assurance of sustainability reporting subject to prior approval from audit committee as part of their other non-audit services procedure?
Thank you. Well, that's an easy one. I like easy questions. So no, because the assurance of sustainability reporting is mandatory under CSRD, and that's going to be the case in each of the 27 countries of the EU. And because this is a mandatory thing, it is not a non-audit service and therefore does not require pre-approval from the audit committee. And there will be other questions which Patrick has alluded to about what is going to be the role of the audit committee in the approval of the new auditor and so on and so forth, but those are questions for tomorrow.
Thank you, Emmanuel. Since we have time left, let me take another question. So the following question is about CSRD. So CSRD oblige companies to describe the due diligence process implemented with regards to sustainability matters. How does this go with companies that are not in the scope of the CSRD? Do we have an answer from you?
Maybe one thing is, and I think I mentioned that earlier, but Carol can certainly complete. Right now, the CSRD is not in force. So there is already in the CSRD reference to standards with regards to due diligence processes that can be used, and those standards are those from the UN and those from the OECD, which are already frameworks which are well known, at least at the largest companies. So for those companies which are not in the scope of CS3D, because the CS3D kicks in at a higher threshold than the CSRD, if I remember correctly, I assume the process will be either to be inspired by the CS3D due diligence framework, or simply as expected by the CSRD to use the OECD guidelines, for instance. Carol, maybe you want to complete that?
No, I agree with you. And really, just maybe let me insist on the fact that the CSRD is really, as I said, a reporting obligation. So I've mentioned the importance of the materiality assessment to identify which disclosure to be made as regards the SRS. Well, the materiality assessment process is informed by the due diligence process. But if you do not have put in place already due diligence initiatives, CSRD does not impose to establish those. So it really refers to what the company already does or not. And if you have due diligence processes already put in place, indeed, some information will have to be disclosed around this. Yeah.
Thank you to all of you. Well, time is running out a little bit, so we need to wrap up this webinar. I would like to thank our panelists for their presentation and all the time they have invested in the preparation. We were not able, unfortunately, to answer all your questions, but we will try to get back to you as soon as possible. I have to say that feel free also to contact us, should it be at ecoDa or also to Mazars. So feel free to contact us and we will come back to you. I hope to see you all online tomorrow. So that will be at 11 o'clock CET. And we will, as it was mentioned earlier, we will have a practical point on the CSRD. And we will have a chance to have Emmanuel again with us tomorrow. And he will be with two senior board members, and the three of them will engage into a conversation. I wish you all a very nice day, and let's keep in touch.
Thank you.
Thank you very much. Have a good day.
Bye-bye.
Thank you. Goodbye.